Hello everyone, welcome to my YouTube channel, and today I want to share my learnings, my insights regarding the markets. So let us go into the backdrop. We have had an 8.5% correction / pullback because of the geopolitical tensions 2 weeks ago. And then after that, we had this fantastic recovery which now negated all the losses that happened in the last few weeks. So now we are at a very critical crossroads as to now how the markets are going to react. Now we are almost sitting at all-time high across all the indices. So moving forward, what is going to happen and what the data tells us? We'll look at all these things in technical and macroeconomic way. So let me start this video by going to the first section, which is macroeconomic analysis. So let us analyze the macroeconomic events. There are few very important key things that are going to happen next week. So first is NVIDIA, that is the biggest player in AI market, is going to announce earnings on Wednesday after market hours. So it would be very, very interesting and very, very important to watch how the earnings of NVIDIA will be and what is going to be their future guidance moving forward. Because many a times what happens is a company delivers great earnings but may not give a very good forward guidance. So there is a lot of high expectations that is built around the NVIDIA stock. So they better give us great earnings until, the pressure mounts and, the stock tanks. So it would be very, very important to see and observe how the market digests the earnings of NVIDIA and how it is going to react. Because we don't need to look at the distant future. Let us look at a very, recent past. Facebook or Meta came out with a great earnings, but they did not give a great future guidance, and that is why the stock tanked and the stock fell too much. So regarding this earnings play, even if you have the earnings before they are released, it is very difficult to predict like how the market is going to react to the earnings. So irrespective of the earnings that are good or bad, we need to wait to see how market responds to these earnings. So it would be not only important for NVIDIA to give the good earnings, but it will be also very important to see the forward guidance picture that they show us. So that is regarding the earnings of NVIDIA that is going to happen after market hours on Wednesday. So far, the earnings of all the Magnificent Seven companies have been relatively stable and good. So it started with Tesla, which had, fundamentally very bad quarter, delivery numbers are less, the margins are contracting, and still the stock went up. And the reason is all of those bad things were apparently priced into the Tesla stock. So that is why I always say, wait for the earnings to get released, and only then you can conclude that how the market is going to react to those earnings. So same happened with Facebook. They announced very good quarter, but the stock fell. Why? Because the Mark Zuckerberg said that they are going to invest more on the AI infrastructure, and they don't see that it would be a short-term gain. It would be a long battle until they see some fruitful changes or fruitful gains in the revenue of Meta. So it would be very interesting to not only see the earnings, but also look and hear about what Jensen Huang has to say about the future guidance and the future demand. So that is the learning that we can take from the earnings, that always wait for the earnings to get released, see how market reacts to those earnings, and only then take the conclusions about the future of the market. So that is one key thing to note. Another key thing to note is Powell is going to speak on Sunday, and that is this weekend. So now, since we have the PPI data and the CPI data released last week, and since we know that the inflation is still about the 2% Fed target, they have very less incentive to lower the rates. So that is also an important point to note, that Powell should be in a no hurry to cut the rates. So the best tool that I have seen to know when and how much the Fed rate cuts are going to happen, it's the CME Fed Watch tool. Now the CME Fed Watch tool is the Chicago Mercantile Exchange tool to see the probability of the rate cuts across the period of time. So let me show you what I mean over here. So in this window, as you can see, I have gone to the CME Fed Watch tool. You can Google it and it should be on the first link. So when you go to the charts and you go to the 12th June, that is the a date of FOMC where the Federal Reserve announced the changes in the interest rates. So if you see the 12th June number, you can see that there is a 91% probability that they are going to keep the rates the same. So June apparently is off the table. Why? Because it's very near and we don't have a very good deceleration in the inflation data. So June is off the table. If you look at the July, probabilities, then the July probabilities suggest that instead of 90+%, now that is 70%. So by that time, we will have one more inflation print of June. So it would be interesting to see because summer is starting. So people will be spending more than they used to spend in the winter. So what implications will it have on the CPI numbers or the inflation numbers would be very interesting to see. So that is the CME Fed Watch tool, which states that, there is a very little possibility of a rate cut until July, which is this one. And I normally tend to go with more than 50% mark. So if you see in the September, you can see that in September, the probability is less than 50%. So, this may be the first rate cut. But this is tricky because in nearing September or November is the peak of election cycle. So I am very skeptical that Fed will do a change interest rates just at the time of elections, because that will raise a lot of questions as to since these elections are coming, you are apolitical, so why are you changing the rates now? So I think if it's not June, then it's definitely going to be after elections, that is, in coming November or December. So this is the Fed Watch tool, and you can see the probabilities of the rate hikes and, the probabilities, in time. So with a definitive time. So you can check out these probabilities according to the month, and you can stay informed, in those ratings. So coming back to the, macroeconomic events, these are, the main things. To summarize, on a macro level, the geopolitical tensions of Middle East are, off the table as of now. Right now, everything is under control until and unless there is, more uprising from Hezbollah, which is on the northern border of Israel. So that market has already digested the geopolitical tensions very well, and because of which we saw 8.5% correction. But now, since we have recovered, now all the entire narratives and all the eyes are waiting for what the AI has in play for us, and how the interest rate scenario and the inflation rate scenario is going to turn out. One key thing to observe is the labor market is softening. So the unemployment claims and the jobless claims, or the numbers, are increasing. So that is one of the key factors to watch. It is less talked about, but it is very important, because remember, Fed has two mandates: maximum employment and inflation. So inflation, they are battling it with higher interest rates, but the if jobless claims and the unemployment rises a lot, then they will be forced to to do financial conditions easing. So that's key in a nutshell. That's my view on what is happening from 10,000 foot overview. So this is macroeconomic event section, and now let's go to the technical analysis section, starting from the weekly time frame. In the weekly time frame, let me discuss support and resistance levels, and then let me discuss my insight moving forward. So moving on to the weekly charts, for all the people who are new to this channel, I just wanted to introduce you that all these candles are weekly candles. And the graph that you see over here is the Fibonacci pattern that I have drawn from the highs of 2021 to the lows of 2022, and then stretching it out to today's date. So what is happening over here is we have seen a huge downfall in 2022 on the weekly time frame, and what I have done is I have drawn a Fibonacci pattern. So since we have almost more than recovered all the losses, and now we are advancing ahead, we need to know like where the consolidation area will be and what should be the price target. So as you know, 1.272, that is this level, was a crucial Fibonacci level, and we stayed there for a few weeks and then it got rejected and then it got support at 26-day EMA over here. But now, since we have recovered all those losses, now what? So on the weekly time frame, the gut feeling that I am getting is I just hope that this should not be the double top formation, that is the M formation. So let me show you what I mean over here. So what is happening over here is this was the top and we are approaching the same all-time high over here. Now on the weekly time frame, it is very much essential for the weekly price action to break this resistance zone. Why am I saying this? It's because if the longer we consolidate near this resistance zone, that is this one, the longer we will be at the risk of having a double top formation. And given the macroeconomic backdrop of higher interest rates and the risk of falling into the recession, this will be a very concerning sign. So in the best case scenario, what should happen is we should consolidate over here for few days and then go higher. But if we are not able to consolidate over here and if we are not able to go higher, then that would be a very concerning sign, because then the price action pattern that is forming over here is looking like a double top. So when I take my marker over here and let me show you what I mean over here. So a double top is, this is the double top, and then again like this. So God forbid, like let's hope that we don't get into a recession and the double top formation doesn't happen. But my job as a technical analyst is to give you all the possibilities and is to inform you that so and so formation is happening on chart. So we better make a note of it and we better position ourselves to hedge the risk. So now coming on to the support and resistance levels, the near term resistance level is this one, this one, which is the pivot level, that is R1 on a yearly time frame, because this is weekly candles. So the only strong resistance that I can see is this one, that is R1 pivot level. And then of course the Bollinger Band, the top of the Bollinger Band is the resistance level. So according to the Fibonacci pattern, by the end of this year or by the end of next year, this 1.618, that is, some people call it as golden ratio, this golden ratio should be the target for the bulls. But remember, this has to be a lot of time, like 6 to 8 months before we go to this golden ratio, that is 20,650 levels. But if let's say we don't go there, and if let's say recession comes, then to achieve this level it's going to take a lot of time. So just wanted to give you a gist of how much important this Fibonacci levels are. And now discussing about the support, the near term support is this blue line, which is 5-day EMA, and the ultimate support is going to be this year to date anchored VWAP and the 26-day EMA, which also acted as support over here a few weeks ago. If you can see, this red line acted as support. So these are not just lines on the chart, these lines have significance. As you can see, this red line acted as a support. So these moving averages are statistical averages which you can select the time period for, and normally 5-day EMA is the shortest term sentiment, and 26-day or 50-day EMA is the longer term or medium term sentiment. So that is how these lines are drawn, and that is how we should conclude the ratings of these lines. So this is it from my side regarding the weekly time frame. Remember that next week it's going to be full of Fed speakers speaking, and since we are hovering near the all-time highs and we closed at the all-time highs, there is a lot of chance of consolidation. So there is a lot of chance of chopping price action next week. So be mindful of that. And as I said, keep a close eye on these support levels and also the resistance levels. There is a very high chance that we test the 5-day EMA next week and then we go higher. So that's all from the weekly time frame from my side. These are the important points that you need to keep in mind when you analyze the weekly time frame. And now let us go to the daily time frame. In the daily chart today, it is very simple and very straightforward. And what I'm going to do is I'm going to show you the resistance levels and the support levels based on daily charts and some of my key insights going into the daily charts. So let us directly jump on to the charts and let me show you those levels. So in the daily charts, as you can see, these are the daily candles. And as you can very well see, we have conclusively or successfully closed above the previous range over here. So as you can see, since last few months, we have been consolidating in this range, and then we went down, and then we again, came to this range, and we have successfully closed above this range. So if you only show me daily charts, technically daily charts are looking very, very bullish. And the thing is, we have now conclusively, closed above this range 2 days in a row. And we have also taken the support at 5-day EMA, that is this blue line, on Friday as well. So as long as the price action is above the 5-day EMA, and as long as we are, above the 26-day EMA and the year-to-date anchored VWAP, that is this one, I think daily chart wise, we are very, very bullish. And the last thing that I wanted to share based on daily charts is the resistance level. So look over here. Technically, there is no resistance until 19,250 over here. That and these both corresponds to the R2 level of the pivots and the top of the Bollinger Band, that is this one. So both of these resistance are coming at one point, that is confluence. So we are getting more and more evidence that the major resistance is over here. And the support is still sitting at the month to date anchored VWAP, that is this white and red line that you see over here. That would be a very good point of support. Now, what I am thinking, or what I am anticipating is until Wednesday, we are not going to have a decisive market action, because all the eyes are on Nvidia's earnings. So let us say the Nvidia comes with very good earnings and the stock market reacts to it very positively, then the upper bound of resistance is going to be this one, that is 19,250. And let us say that Nvidia comes up with bad earnings or bad future guidance, then the support is going to be again the month to date anchored VWAP and the 26-day EMA. Right now both of them are sitting over here, that is 18,150. So the volatility band or the potential move is very, very big, also on the upside and also on the downside. So this is going to be a very, very crucial week for the markets to decide the next leg of the markets. So right now AI story is fueling a lot of growth. It is showing a lot of promise with the release of GPT Omni. A lot of companies are doing well. So we'll have to wait and watch and see how markets are reacting to these, and how markets are taking these numbers and advancements. So yeah, daily chart wise, it would be a paradise for the traders who are intraday traders, since the potential of upside move and the potential of downside move is going to be very, very high. So for the investors, I would say wait and watch and see how markets react to these things. But for the day traders, it is going to be very, very huge moves next week, starting from Wednesday after market. So that's my take on the daily time frame. I have discussed the resistance over here and I have discussed the support over here. So in the meantime, everything in between is noise. So just keep that in mind and keep all these levels noted, so that you can take informed decisions. So now let us go to the daily charts of anchored VWAPs, where I have some important updates for you guys. So this is by far my favorite section in the video, and why? It's because I discovered about the anchored VWAPs a few months ago. I have been researching about it, and I have read a book from Brian Shannon, who is an absolute authority when it comes to the anchored VWAPs. And the reason why I do incorporate anchored VWAP into my analysis analysis is because they are so much effective. So let me show you all of these in the charts, and let me also show the updates and the new anchored VWAP mounting points that I have made on the chart, which would be very significantly important moving forward. And I have specifically color coded each of the anchored VWAPs, and I have labeled to the mounting point, and I have also labeled the reasons for those mounting points. So as you can see, the market fell down 8.5%, that is on Nasdaq index, and as you can see, it exactly bounced from the level of October lows anchored VWAP. So as you can see, in 2023 there was in the month of October we made the lows, and then I have mounted this anchored VWAP over here, and you can see fast forward moving on to April 19th, this October lows got validated and it acted as a very strong support, and the markets actually reversed from this point. So you might ask the question like are the other anchors not important? They are absolutely important, and as a technical analyst you also need to know that all the levels are support and resistance levels. So there is a high chance that they hold, but if they don't, then the next level of interest or the next level of support needs to get validated. So this is how the study of technical analysis works. So the key updates for today's video is this white anchor that you see over here is the lows of April, which was because of the geopolitical tensions and the higher rate fear. This was the lows that were created, and this was the perfect mounting point for the new anchor. So this white line is the new anchor of 19th April lows. Also there was a very good change in the momentum, and whenever such price action happens, Brian Shannon calls this as a handoff. So I have plotted this handoff over here, and this yellow line is the 2nd May handoff. So these are the two anchored VWAPs that I have added. I have also added an anchored VWAP for the PPI data, that is producer price index, and also it was followed by the CPI data release, that is consumer price index data release. So both of these are the gauges for the inflation numbers. These events or these data releases are going to be very important going forward, and that is why I have anchored one of the days of PPI data over here, and this is the anchor. Now look at the beauty of anchor VWAP. On Friday, we perfectly validated this, and then we bounced back from this. So if I go to the hourly time frame, you can see over here, we actually tested the anchored VWAP and then we bounced back. So these levels are critically important, and they often act as a support and resistance levels, and that is why we track them, and we make sure that we note them and we take advantage of them to make money as traders. So this is where I'm coming from. So these are my important anchored VWAPs, and these are the color schemes that I use, and so on and so forth. Right now the price action, as long as it is above the PPI data anchor, that is this white line, there is no reason to be bearish. So right now markets are in a very bullish condition, and right now any dip has to be bought. So until and unless it is proven guilty by breaking down below this support, there is no reason to be bearish. So let's see how the market unfolds, but as of now the anchored VWAP are looking bullish. I wanted to discuss a miscellaneous topic with you guys, which was concerning to me since last few days, and that is inverted yield curve. So when I say inverted yield curve, I am talking about the 2-year and the 10-year treasury bonds. So the yields on those bonds ideally should be, the 2-year should have less yields and the 10-year should have more yields. And why? It's because if the investor is willing to keep the treasury bonds for 10 years, then ideally they should be rewarded more than the investor who is willing to take that risk for 2 years. But since so many months, we have seen that the short-term yields, that is 2-year, is more than the long-term yield, that is 10-year. So that brings to the $1 million question: is the inverted yield curve gonna cause a recession? So let us see on the charts what do I mean over here, and let me show you like when this inverted yield curve happened in the past, what happened with the recessions and when it came. So if I go to my trading view and if I show you, at least for the last 2 decades, all the times the curve has inverted and all the recession that it followed, let us analyze each and every situation. So if you look over here, this was the 2000 era, that is the time of dot-com crash. So if you look very closely over here, the inversion of the yield curve started in February of 2000. And we got a recession, or we got a dot-com crash in 2001 and 2002. So it almost took at least a year after the inversion took place to have a recession. Let's go to the next recession, which occurred in 2008 or 2009 because of the Lehman Brothers, real estate crisis. So the inversion happened near January or February of 2006. And then you can see it again inverted in June of 2006. So it took a good 1.5 years for the recession to follow. Then let's come again to the latest COVID recession. So the inversion happened around 2019 August. So we got a recession in 2020, right? So that may be because of Corona, but whatever, the past data up until now suggest that after inversion of the yield curve takes place, we get a recession on an average after 6 to 8 months. So look at over here. Now this is really concerning, and this is why I'm sharing this. Look at the inversion of the yield curve. In March of 2022, we got an inversion, but we went back, and then again, we got an actual inversion and the breakout on June the 1st, 2022. And since then, we have stayed inverted for a good amount of, let's say, 1.5 years. So this inversion is very deep as compared to the inversions in the past. So look at this inversion, look at this inversion, look at this inversion. These are the inversions where a lot of recessions followed. And if I consider this inversion, this is the deepest inversion we have seen in last 2 decades. So I'm not calling in for a bear market crash, and I'm not calling in for, go out there and short the markets. What I'm saying is the data is suggesting that we have been inverted since a long time now, and there is a very good, reason to be cautionary and not deploy capital at these levels, especially when we are sitting on all-time highs. So what I'm saying is have, 6 to 8 months of emergency funds, and God forbid if something goes wrong or something goes south, then you will have dry powder to deploy. The next thing that I wanted to discuss is it's the timeline of the recession after the inversion takes place is varying to a very large extent. So because of this election cycle, because of this good consumer strength, the elongation or the timeline may change, but there is a very high chance, like statistically, that we may face a recession. Now the thing is, one thing about the recession is we don't know how deep it will be. We don't know how bad it will be. Is it a 25% crash? Is it a 50% crash? Nobody knows. So what I'm suggesting is, have a game plan in mind, have a reserve fund, because these signals, data is purely, like, there's nobody who can deny it. So the records so far favor, a mild or a, moderate recession. So let's see what happens. But every time you see the 2-year and 10-year inversion like this, the result is not that great historically. So this is what I wanted to share. And remember, the inversion or the bonds that I'm considering for this yield curve is 2 years and 10 years. So that's what I'm showing you over here. Be prepared if something goes south. So that's my take on this miscellaneous topic. For this section, let us talk about the economic events that are important going forward next week. So today, that is Sunday, at the time of the recording of this video, Fed Chair Powell is going to deliver his remarks. So that is going to be essential because remember, last week we have PPI and CPI data, and we have to know like how Powell is interpreting those data and what he has to say about it. So that would be important to see, like how is he, reacting on the latest CPI and PPI prints. So that is important. And then in this week, mostly a lot of Fed speakers are speaking. So many times what happens is there are non-voting members of FOMC committee like Fed Kashkari, which, says, bad remarks or, hawkish remarks and brings down the market, even after, being a non-voting member of FOMC. So there are lots of Fed speakers speaking. So always make sure that if you are day trading, you don't take a big position when one of the Fed speakers is speaking. speaking. So that is one of the key important things to note. Apart from that, we have FOMC minutes that are going to be released. So if you see over here on Wednesday, 11 o'clock Pacific time, the FOMC minutes will be released. So that would be, an important news point for the markets. And then obviously, on Thursday, we don't have a big, thing apart from the 10-year note auction. And then on Friday, we have Michigan consumer sentiment. So that is going to be crucial. So all in all, like macroeconomic news wise, we don't have that much, big important data releases as such. The only thing is a lot of Fed speakers will be speaking, and we have FOMC minutes. So that's the main thing. The only key thing going forward is how Nvidia is going to, give the earnings and how market is going to respond to those earnings. So Monday and Tuesday markets are, expected to be flat. And then the real price action will be seen in the after market hours after Wednesday. So there is a lot of chance that we may face sideways action, and there is a lot of chance that Nvidia, even after giving good earnings, tanks. So we'll have to see what happens, and we'll have to listen to Jensen Huang's speech. But apparently that's the schema of this entire new week, next week. So be aware of these timetables. So lastly, I would like to thank you all for viewing this video, and I hope that I'm bringing, valuable quality content that is making you a better trader or a better investor. So these are my insights, and I hope to see you in the next video as well. Please like, share, and subscribe so that it gives me enough motivation to do all this. So thanks and have a great day.